Plenty of room up front. Hello, everyone. Try that again. Hello, thank you. Hello, everyone. Thank you. Hi, I'm Sarah Rosen-Wortel. I have the great honor and privilege of being the president of the Urban Institute and also of being your official welcome today. I want to take a moment and thank both of those of you who are here in person. It really always improves the events, but we also have a very large audience that was registered to log in online. So our greetings to all of you around the country who are joining us as well for a conversation about the past, present, and future of credit scores in housing finance. Before I do a more formal welcome, I want to do all the housekeeping logistics, which I am required to do as well. First of all, as I mentioned, this is hybrid, and we're grateful to everyone for being here, but the event is also recorded, so you can, if you're watching it later, welcome as well. And we will post the recording online on our website in the few coming days. There will also be bios for today's speakers and slides from presentations that you'll see available on the event webpage as well. We also have live captions enabled for virtual attendees, and you can turn them off if you prefer during the event, and there's a little toggle down at the bottom. You can also submit questions, whether you are virtual or otherwise, by using the form that is shared in the chat. Here in the room, you scan the QR code that is on the table if you would like to submit your questions via the form as well. All right, so why are we here? This is a more timely than we expected when we first announced this topic, a timely and important conversation on the role that credit scores play in the housing finance ecosystem. And the conversation will explore some of the innovations and emerging technologies that are driving progress in credit scoring as well. Credit history is a primary financial gatekeeper in the American housing finance system. Over the years, Urban Institute research has demonstrated through evidence-based, data-driven analysis how homeownership could be more attainable, particularly for underserved borrowers, if aspiring home buyers understood their credit picture and knew how to build a strong credit score. A consumer's credit score determines both their access to housing and its cost. We tend to think of its relevance in the mortgage industry and in other credit decisions, but actually credit scores also affect access and cost in rental markets as well. Credit scores are used as a risk assessment tool by mortgage lenders and landlords to directly influence both approval decisions and pricing structures. So today's program has two full panels of experts who are going to talk about the role that credit scores play and look at the future of how emerging technologies and alternative data are already impacting the credit scoring and will impact how they shape housing finance ahead. And I expect, too, that they will talk about the implications of some recent policy developments as well. Today's event is part of a larger body of work by my colleagues in the Housing Finance Policy Center that covers rent reporting and alternative data's impact on credit scoring. They've been doing this work over a number of years, and if you put credit score into the website, you will find a rich set of insights. But before I introduce the speakers and let you get to the people who really are the experts here today, I want to say thank you to a number of folks who helped to make the work of the Housing Finance Policy Center possible. They are the supporters of the Housing Finance Innovation Forum, as we call it. Without their support and contributions, today's event would not be possible. And we're particularly grateful for the thoughtful subject matter contributions we're going to have today from two of the HFIF Forum members, our friends from FICO and Zillow, who are on today's program. And so with that, I'm going to turn it over to Jung Chow, who is a principal research associate here at the Housing Finance Policy Center. She's going to kick us off, as we always like to do, with some table setting, level setting presentation on the historic use of credit scores in the finance system. Thank you, everyone, for being here, and I look forward to seeing what we all can learn from each other. Thanks. Okay.
Hey, thank you, Sarah, and good afternoon, everyone. Thank you for joining me today, both in person and also online. Before the two panels, I will provide a quick overview of the past, present, and future of credit scores in housing finance. So here is what I will cover today. First, we will take a quick look at the past history of credit scores, followed by some look into the current usage of credit scores in housing finance. And then I'll end with introducing some recent innovations in credit scoring and credit evaluation. So let's first take a look at history of credit scoring, especially how it all got integrated into the current mortgage market system in the US. So before 1950, credit decisions relied on scarce data and often based on personal relationship. In 1956, FICO company was founded by William Fair, an engineer, and a mathematician, L. Isaac. And their idea was to use statistical methods to quantify credit risk of individuals. In 1960s and 70s, this is the period where we saw a formation of national credit bureaus, which began to consolidate regional and local credit files. Over time, three major agencies emerged: Equifax, TransUnion, Experian, offering broader and more standardized credit reporting services. In 1970, Fair Credit Reporting Act was enacted, requiring credit reporting agencies to ensure the accuracy, fairness, and privacy of consumer information, laying the regulatory groundwork for more formal credit evaluation systems. In 1989, FICO released their first FICO score, which provided a standardized way to access borrower risk. So before FICO score was launched, mortgage underwriting was still highly manual. So in 1995, after multiple years of doing a pilot, Fannie Mae and Freddie Mac formally adopted credit scores into their automated underwriting system, which really enhanced the efficiency in the mortgage underwriting. And in 2006, in 2000s, there had been a continuous expansion of using credit scores in the mortgage system, which I will cover in later slides. And in 2006, Vantage Score was launched, but it hasn't been fully adopted and implemented yet in the mortgage industry. But in the most recent time periods that we're living in, FHFA did approve FICO 10T and Vantage Score 4T, which does incorporate alternative data like rent reports and utility payment in the scoring models to be used by the GSEs. We are still waiting for the full implementation to happen. So this chart shows that credit scores are used throughout the housing finance system. So many people, probably not people here, but then many people outside the mortgage industry thinks that credit score may be heavily used to determine borrower eligibility of accepting or not accepting the mortgages, but it's actually used by servicers, insurers, GSEs, investors, and also the regulators. So let's look a little bit more deeper into how it's currently being used in the mortgage finance system. So currently, actually, both GSEs do not directly use FICO scores in their AUS to determine whether or not to approve a borrower, but they do require the lenders to submit FICO scores to determine borrower risk to use it in their risk-based pricing models and determine interest rates. However, credit scores are still used to determine the minimum eligibility of the borrower, which is currently a 620 FICO score. It is also used by mortgage insurers to determine eligibility and set premiums, and to access the loan pool and quality and the MBS risk by the investors, GSEs, and credit agencies, rating agencies, and services use it to identify risk and tailor workout options. And it also is used to determine the capitals that GSE needs to hold to weather a financial crisis. So while I mentioned that FICO scores have enhanced efficiency in the mortgage market, still there are people who are left out of the system. So according to a CFPB report previously, they find that about 20% of individuals do not have classic FICO scores because they don't interact with the system, or they are have very limited data in the system. And also very frequently mentioned reason for mortgage denial is credit history. About 20% of the mortgage borrowers are declined from getting a mortgage because of their credit history. So with the advancement of data and then also technology, there has been greater discussion of the potential of these new data sets that can be incorporated into the credit scoring models or be used directly into mortgage underwriting. So these data includes rental payment history, utility telecom payments, bank cash flow data, and also transactions related to buy now, pay later. So here I will be focusing on recent innovation related to the rental payment history, which has seen the greatest kind of like movement in the recent couple of years. So there's like largely two ways of incorporating rental payment into mortgage underwriting. First is facilitating rent reporting and also using rent payment incorporated credit scores in mortgage underwriting. So, so the GSCs have, in the past couple of years, I think starting from 2021, incentivized multifamily property owners to report tenants' positive rent payment histories. And also a couple of fintech companies, including Built Rewards and Isuzu, have made it easier for property owners to report landlords and tenants to report rents to the credit bureaus, and also Zillow and Amazon and WHC have also done some work in this space. FICO score 10T and VantageScore 4.0, as I mentioned earlier on, has been recently approved to be used by GSCs, but it's still waiting to be implemented in the housing finance system. The second way of evaluating rent reporting in mortgage underwriting is to examine rental payment directly in mortgage underwriting by accessing bank account data. And both GSCs have started and expanded evaluation of on-time rental payment history in their desktop underwriting. And FHA also followed similar steps in their total scorecard models. And several companies, including Formfree and Plaid, have improved utilization of bank account data through advanced technology. So what is the potential impact of including alternative data? As a researcher, I would say that we do need more research in this space, but then several research, including ours, do suggest that if you include positive rental payment history into the credit models, on average, it does increase the credit scores, and that increase is greater for those with low scores or no scores. So we do see a disproportional benefit among those who have been kind of facing difficulty of building credits. And also GSCs have done some early studies in this space to evaluate cash flow underwriting, and they do find that if they access the bank account data and evaluate borrowers, they tend to kind of like expand the credit box slightly to those who were previously underserved in the mortgage market. So we do see that a potential of adding alternative data into the credit scoring and then mortgage system could potentially expand the credit box safely and also lower the cost of mortgages for some borrowers. However, there are some additional existing barriers that we have to address. First is data collection. So although there has been more efforts to include rental payment history into the credit bureau files, less than 5% of rental payment history is currently in the credit file. So even if we somehow, like you all use like FICO score 10T and VantageScore 4.0 today, it's not certain that this will really kind of like move the needle in a significant way, because we still need to do a lot of work on reporting the rent payment data into the credit files. And also, we have seen some evidence that receiving consumer permission to accessing bank account data has been challenging. One of these challenges related to the lack of consumer awareness. We did a survey asking the renters how do they report their rent to the credit bureaus, and about 45% of the survey respondents says they're not sure. And even those who said they do report their rent to the credit bureaus, they said a lot of them say they don't know how, so they might also be very misinformed about whether or not their rent is being reported. We also need to do more work on data standardization and also provide clear regulatory guidelines to ensure responsible use of consumer information. So with that, today's panel will cover largely two topics in this space, which is very timely. The first panel will look into how credit scores are used in housing finance ecosystem, as well as what role do consumers have in understanding their scores. The second panel will be focusing on how innovation, emerging technologies, and alternative data affect credit scores and access to credit in the future. So with that, I would like to invite our first panel with Lori Goodman, who will be moderating. And I will go back to my seat and also engage with my online friends who are attending this event. So thank you very much, everybody.
Well, thank you, Jung, for that excellent presentation, and it's so great that so many of you are here today, both in person and virtually. I would like to introduce my fabulous panel in alphabetical order. Actually, in order in which they're sitting. Jim Bennison, the former Executive Vice President and Head of Alternative Markets at Arch Mortgage Insurance. Ken Brevoot, the Principal Economist at the Federal Reserve Board. Mike Croxon, the CEO of the National Foundation for Credit Counseling, and Pete Sepp, the President of the National Taxpayers Union. Thank you very, very much for participating in this panel. We really appreciate it. I'm going to ask a series of questions, and one of our speakers is going to lead off on each question, and then the others are going to join in behind, depending on how vigorously they raise their hands or otherwise illustrate that they want to talk. So let's actually start with Jim, and let's talk about how credit scores are used by the GSEs and the mortgage insurers, by investors in GSE, CRT, and also other types of securities that involve mortgage credit. So, for example, non-agency securitizations, the CRT deals done by mortgage insurance companies that you were so heavily involved with. And then how do investors look at this? Does it improve liquidity? And what changes have you seen over time based on your long history in the market? So, Jim, why don't you start with that?
I'll start with the last question and work my way forward. So with regard to what changes have occurred, I think one of the things that was outlined in the prior speaker's timeline, FICO scores were really adopted in the mid-90s in the case of mortgages. And in fact, I can remember early in my career having a conversation with Fair Isaac's representatives right before that happened, where they actually expressed some reticence about using FICO scores for mortgage finance because they felt that the predictability of the score was tied more closely to shorter term credit as opposed to a mortgage, right? Obviously, there's been decades of evolution with regard to the scores, market participants' use of the scores, the give and take between those participants and Fair Isaac's. So the evolution has been significant to the point where we are today, and really all market participants, whether you're an investor, an insurer, reinsurer, a GSE, a bond investor rating agency, they've all come to coalesce around a relatively common view on how to think about the credit score as it is today, the FICO score as it is today, and that relates to the liquidity in the marketplace. you've created a base standard by which market participants, buyers and sellers of mortgage credit risk, can communicate with one another and have a base understanding of the nature of the risk that they're looking to either purchase or sell. And that's critical to liquidity. The vast majority of mortgages in this country are not, they're not owned by the originator, they're sold. And so you're looking for pools of capital across the globe that are ultimately going to fund the mortgages in the United States at the best possible price. And that gets to, now I'll talk a little bit about how credit scores are used by mortgage insurers and as a template for how other investors would be looking at it. You know, credit score is one element of the mosaic that is used to determine the probability of default. So at the end of the day, as an investor, as an insurer, I'm most sensitive about the certainty around the type of risk that I'm taking. The less certain, the more I expect to be compensated for taking that risk. The more certain, I'm willing to offer my capital at a better price. Credit scores are a piece of that. It's not the only element, but it's a nice, convenient way of assessing borrower credit quality, which gets to the probability of default. And so from a mortgage insurer's perspective, those scores are important in terms of our risk models. How do we evaluate the risk on the mortgages that we're taking, which then translate into our capital models. And you know, how much capital do we need to hold against the risks that we are taking? And that leads directly to our pricing models. How much capital do I need to hold? And what type of return do I need to get for that risk? And generally, that's true for any investor. You know, there are going to be some differences as whether you're an insurer or a cash investor, but for the most part, those are the considerations. And FICO is absolutely critical in helping determine what those pricing levels are going to be, what the capital levels are going to be, and ultimately what risk you're willing to take.
Who would like to follow up? Pete?
Well, I guess I'm lead off man. So we tend to look at many of these issues from the taxpayer and the private sector perspective of how are various regulatory mandates or policies that are encouraged by government or quasi-government entities going to affect the total cost of the system, not only to taxpayers but the business sector. And of course, commenting here on Jim's remarks, it's very important to remember that part of the liquidity and stability equation is stability of policy and certainty in policy. If you have a credit scoring model, for example, that is highly predictive of borrower risk and helps investors make decisions, it can be highly predictive of taxpayer risk. It can be highly predictive of contagion risk in other government programs that might utilize credit scores in one way or another. And what we have is a recent shift in how credit scores are used, how they will compete with each other, how the models will be evaluated. That involves, if they are implemented, private sector costs that have to be accounted for and built into the process. When Sandra Thompson, the former FHFA director, was proposing one of 4 options to reintroduce credit score competition, the estimated private sector compliance costs ranged from $374 to $614 million total. The option that was eventually selected, and which is now kind of up in the air, had a midpoint of about 450, 500 million. Many people in the private sector thought that was low. And so those burdens have to be taken into account as well.
Let me just add, that's a direct cost, but the other element here that's important is the uncertainty that introduces into the system. That results in an increased risk premium that investors are going to demand just to put the capital to work. So there is the direct cost, so I've got to spend a lot of money to upgrade all my systems, my algorithms, what have you. But then I've also got to look at what the outcome of these changes are, and does that improve the certainty or reduce the certainty of projected outcomes? And if it does the latter, you're going to end up seeing investors demand more compensation for putting their money to risk.
That's right.
Ken, would you like to add anything on the,
Yeah.
in terms of how credit scores are used?
Yeah, actually, before I say this, let me remind everyone, these are my opinions, not those of the Federal Reserve Board or its staff. And so one of the other parties that's involved in this type of decision-making, though, are the consumers. And there may be consumers out there who would benefit from some of the newer scoring models that are being developed. And I'm not just talking about whether you open up competition to FICO and VantageScore, but also FICO and newer versions of FICO. Right? If these new models tend to do a lot better job of determining who is a real credit risk and who is likely to repay, to the extent that the industry doesn't evolve toward those more newer and more accurate models, consumers may wind up in certain cases being hurt by that. And I think there has been a perception, at least, that the industry has not moved to some of these new models as quickly as some may have liked, and that may be having implications for consumers.
Yeah, and I think another piece of that is, one of the presumed underlying elements of the new models is to expand credit availability to consumers who otherwise have not been able to access it traditionally. And to your point, it gets more expensive.
Yeah.
So, the very people who can least afford to pay more become a bigger risk. And so the question is it a benefit or is it not a benefit? Time will tell. Yeah.
And actually, let's now turn to the borrower side or the consumer side. We're going to start with Mike on this. This is actually the first time I have seen a panel where your last name starts with a C and you were the third of 4 panelists in alphabetical order. I must say that was sort of jarring as I looked at my notes. But anyway, how aware are borrowers of their credit scores, or how aware are consumers in general, and what more can they do to understand and improve their credit scores for the purpose of pursuing home ownership? You do a lot of work counseling potential homeowners. What are your insights there?
Thank you. And so let me start with a little context. The consumers that I'm talking about are principally going to be low and moderate income. They're going to be in the moderate income category. Of the hundreds of thousands of consumers that we counsel every year, roughly 40% are below 50% AMI, then 20% 50 to 80, 20% 80 to 100, 20% over 100. So it's a pretty broad spectrum. Credit scores range from upper 400s to 800, so there's a pretty broad distribution, but the average is right around 650. So for this consumer, it's funny, looking at that timeline we saw earlier, I'm thinking 1995, this gets introduced, right? Well, I'll tell you what I remember about 1995. It was, I'm thinking of a number. Anybody remember this commercial? I'm thinking of a number. It's mycreditscore.com, right? That's when that was introduced. It's when consumers first got introduced to the idea of credit scores. And I believe that the proliferation of unsecured debt and access to unsecured debt in the context of credit scores is the way that all consumers, including low and moderate income consumers, think about accessing credit. So when they go to Credit Karma or they go to a sponsored link from a lender to see if they can be pre-qualified for a mortgage, it says you're going to need this credit score. That does not tell the borrower all the other things they need. So for example, if you have a co-borrower, it's the tri-merged middle score lowest. One of the trends that we've seen with consumers over the last 2 years is that what used to be 50-50, consumers who had never applied for a mortgage, consumers who've been denied for a mortgage, 50-50, it's now 60-40 denials. So we're seeing the population get turned down more. There's a lot of reasons for that, right? Housing costs, interest rates. But the consumer's context hasn't changed. They do not know the rules of engagement in the mortgage underwriting space. And the key is making sure that they understand what the rules are, how to get there. I'll go a step further. I have, as a former banker, I don't have any issue with sponsored ads, right? But at the end of the day, the consumer needs to think about the fact that you probably don't want to take guidance from the person who's going to lend you money. Their interest is not in necessarily giving you the most right product. It's once they've got you in contact, is to sell you a product. And if you, in a technology-driven environment, once they have you, if you get turned down, it didn't cost them anything to turn you down. It will cost them more to keep you if you don't match, and they move on to the next person. So there's a need around education irrespective of what happens with the model, I think.
And Ken, why don't we
Yeah.
move to you with this
One of the
question?
other things that comes to mind when I think about consumers and their role in this is that consumers play a really critical role in credit reporting in particular, largely in that the information that comes into a bureau, even if the bureau is well-intentioned and wants to do a very good job, they have no way whatsoever to verify the quality of that information. Right? They get input from a credit card company saying they paid this amount of money, you were delinquent or not. Is that right? They have no way of verifying that. The consumer has to be the one to do that. Right? Even if you're a government agency, you also want to sort of look over an industry and make sure that they're doing enough to verify the quality of this data. You know, if you're the CFPB, you also have no way to verify the quality of this information. So it is it's inherently the responsibility of the consumers to make sure that the information that's being used to make these decisions about them is accurate. And the only way that you can really verify the accuracy of that information is to enlist the consumer. Right? The FTC, I think, probably about 20 years ago or so, was asked by Congress to evaluate the accuracy of credit record data. And the only way they could come up with to do it was to actually get a bunch of consumers, put them in a room, have them look at their credit file, right? Because that's the only other source of information that you might use to verify that information. So the other thing that is really important about what consumers do and their role in this process is to make sure that this information that's being used to create these scores, whether they understand the process of those scores or not, accurately reflects their own credit history.
Jim, do you have anything to add to that?
Well, I admittedly, as an investor, I fly a little bit higher than at the individual consumer level. But I do think at the end of the day, as I said earlier, we need to have as accurate a score as possible, and the highest predictive value would follow suit. You know, I do worry a little bit about some of these changes and what they're really going to ultimately, what the effect is going to be. Particularly, I think there's a short term and a long term. Longer term, I think the benefit of having a competitive environment for credit scores, it's hard to argue that that wouldn't produce some benefit. But in the short run, depending on how it's implemented, if it results in less certainty as to the predictive value of the credit scores that investors are using to evaluate the risks that they're taking, there's going to be an increase in cost, and that will get passed on to the consumer. So I think the implementation around the execution of moving to having multiple options in the marketplace needs to be seriously considered.
Yeah. I would just add that public policy can assist the quality of data and help consumers understand it at the same time. There was a bill being drafted 2 Congresses ago, I believe, from Senator Tim Scott that would involve government housing authorities more directly in the collection and distribution and monitoring of rental data in public housing. Not a bad idea at all. I mean, you would create almost an environment between the private sector, credit score developers, the models, and the government in assessing the quality of the data and the inputs in the first place. And so you're creating a sort of regulatory sandbox that could be very useful in enhancing quality.
Ken, you've done so much research on credit scoring through the years. I've probably got like a stack of your papers, yay high. Can you provide an evaluation of the strengths and weaknesses of credit scores? And then let me actually follow that up with, earlier you had mentioned that the newer versions that were approved, the FICO 10T and Vantage, are better than sort of perform better than the classic FICO. And if you could follow up on what some of those strengths and weaknesses are, that would be terrific.
Sure. So in a lot of the stuff I write, I always wind up focusing really a whole lot on the weaknesses of credit scores, because those are a lot more interesting to write about. So let me make sure I get into some of the strengths, right? The fact that you have these models, some of which were built in the early 90s that are still predicting performance today, is kind of remarkable. So the ability of these models to take a really complex amount of information, if you've ever gone through a credit record, there's a lot of different pieces of information that you need to weigh. The idea that you have something that could evaluate those and give you a realistic way of how to sort of rank a consumer relative to other applicants that might be out there in a matter of seconds at a relatively low cost in a way that has been shown to be robust over a long and varying business cycle is pretty remarkable.
Yeah.
So let's talk about the weaknesses. So one of the areas where these models necessarily struggle is, of course, those people who do not have a lot in their credit report, or people who have nothing at all. Right? Now, I can build a credit scoring model that would produce a credit score for somebody who does not have a credit file at all. It'd be very easy to do. Right? I have no information to differentiate between people who don't have one of those credit reports, so I'd have to give them all the same score, but I could do it. The problem is that that score is going to most likely be terrible. Right? If I actually use it, there's no guarantee, particularly that when these people become scoreable, they're going to continue to perform the same way otherwise. And you have sort of the same problem when you have people who have only a tiny bit of information in their credit report. Right? Take somebody who had no credit report, all of a sudden you have now a debt collection for a Sprint bill they didn't pay for $20. Their score, their performance could be consistent with anything from a 300 to a 7 to an 850. How do you, based on that little bit of information that you know, come up with a number that predicts them? Right? And so the challenge is to sort of decide exactly how much information is necessary to make those scores reliable. And that's something that these models really struggle with. And one of the important things, I think, to keep in mind is that just because you can produce a number doesn't mean that number is any good. And so what you want to do is you want to be able to evaluate in your context in which you're using the data, does a credit score based on some amount of information accurately predict delinquency for the population that you're looking at? And you want to make those sorts of decisions. So it's not really a question of, you have these thin file people out here and they are unscorable, and now we can make them scorable, therefore we've improved the world. You fundamentally need to know whether those scores are meaningful and are they accurately predicting things. The second weakness that I spent a lot of time thinking about with credit scoring is the fact that they are tremendously opaque. And we've talked a little bit about this already. Consumers don't really know necessarily where these numbers come from. They don't know what they mean. They don't know how to fix them. If they see that their score in one model is this and in their other model is that, they don't necessarily know why those two numbers are different. And that makes it really challenging for consumers in terms of knowing where to shop or how to shop. Which lenders should we look at? One of the pieces of research I did that I personally found most interesting was we used to do this evaluation of mortgage lending in 2000, and every year. And around 2007, when the subprime portion of the mortgage market collapsed, lending was down across the board, particularly in the high segments or high price segments of the market. Right? Subprime lending was down 85% for every demographic group you looked at. If you looked at loans that were closer to prime, also down, not quite as much. If you looked at people who were just sort of above what would be considered prime, we found something that was really remarkable. I don't know if Bob Avery's in the office or in the room today. I think he was on the list of people who are going to be attending. He and I were working on this together. What we found is that they were down for whites, down for Hispanics, down for Asian borrowers. They were up 20% for African Americans. Mortgage loans of just above prime interest rates were up in 1997. We were so surprised by this, we immediately went to the RA who generated the information, told him it was obviously wrong and to redo it. And he spent 24 hours trying to fix this thing, came back to us quite irate saying, no, it's right. And what we realized is when we looked at the data closely, is what happened is that increase in lending that we'd seen was in exactly the same neighborhoods with 169 subprime lenders that had disappeared in 2007 had previously been most active. So what we're pretty sure happened is that you had a lot of African Americans in these communities who misunderstood what their credit was, and as a result went to subprime lenders where they got subprime loans. And when those lenders disappeared, when banks were the only game left, they wound up getting loans that were pretty close to prime. And part of that is caused by the fact that people don't necessarily know what their own creditworthiness is, and that affects how they go and make loans. I'm sorry, you wanted me to also get into
if you could just talk about the improvements in Vantage and 10T over sort of classic FICO, what the differences are.
Yeah, well, I think the difference is a lot of it is increased or improvements in modeling. It may also be better data that's being out there. You have a lot more potential to use machine learning and things like this. I think a lot of these are going to be overblown. This is my own personal view. Again, not the opinions of the Federal Reserve Board or its staff. But I think as you sort of learn about these modeling techniques, you learn different ways of building these models, different way of segmenting the scorecards and all the rest. And it does fundamentally allow you to build more accurate models, right? And so I think a lot of these improvements do offer the potential to really improve, particularly for the people who have a lot of information out there, the forecast of what their likely delinquency is. A little bit harder, again, if you've got people who only have like one account that's out there that's maybe been there for 30 months, your machine learning is not really going to help you there, right? Because fundamentally, not a lot of data means not a lot of signal. If you have a lot of data, yeah, you may be able to use more advanced modeling techniques and pull more signal out of that. But fundamentally, the people on the margins of the credit reporting system are always going to be a little bit more hard to predict. But for the massive people, these newer modeling techniques should allow you to better separate the really risky populations from the less risky populations and make better decisions.
Jim?
Quick question. I guess as panelists, we can ask each
Oh,
other.
please, ask Ken all the questions you want.
So again, my focus is mostly on accuracy and predictability. And when you're talking about these new models and potentially being more accurate, how can you make that statement given that we haven't yet gone through a full credit cycle with these models? Do we really know that they're more accurate, or we?
Well, I should say that I myself have not evaluated the quality of these models because I don't.
I think I raise it because I think that's one of the challenges
that's
from
exactly
an
right.
investor's perspective as we look at these models as they are new scores are brought in. You know, the reality is, and again, as I mentioned earlier, you got a longer dated credit obligation here with a mortgage, and to truly evaluate the efficacy of a score and its predictability, you're going to need to look at it through a cycle.
Yeah.
And you know, cycles in the mortgage space, thankfully, they exist, sadly, but they take a long time to unfold.
Sure.
So I think, again, when I get to short-term versus long-term benefit of these developments, part of that, my long-term focus on it being beneficial in the long term is that for a period of time, it's going to take time for these scores to gestate in the marketplace and for investors to be convinced that they represent the same level of predictability that you had with the existing ecosystem, so to speak.
Right. And one of the things that you can do right now, though, is you can go back to the historical data, rescore these applications,
Yes.
and see if those play out. I totally take your point.
Yes.
That's not the same thing as observing in real time. But fundamentally, if that starts to show you, there is some lift here in terms of additional performance.
That raises another interesting question with regard to historical data. And you know, one of the little irritants that I've had over the years is the fact that while there has been a tremendous amount of data that has been provided, particularly by the GSEs, the data through the housing crisis or the financial crisis has been scrubbed. So they made a judgment as to what loans are currently being originated versus what was originated leading into the crisis and excluded those that they deemed no longer in the market. The problem is that lack of data about those products and the credit features around those products is a big blind spot as we continue to move forward, and we're once again in an environment where people are looking to, whether it be credit scores or otherwise, look to maybe reintroduce some of the same features that may have existed. We call it something differently, but functionally it may be very similar to what existed. So I think one of the things that could help from an investor perspective is, to the extent that we can continue to get more and more data that is out there or exists somewhere, would be helpful in this exercise as well.
Yeah. And while we're commiserating,
Sorry, you got me on. I didn't expect to get into that discussion.
I would go off
but
tangent now
yeah.
too. While we're commiserating about blind spots,
Yeah,
one
yeah.
of the things that also I have some concern about is that you're seeing these periods now where it's much more common where when the economy goes a little bit south, where you have a lot of forbearance being used. And in the past, you just don't. And what is that going to do for the ability to verify the quality and accuracy of these models if you have these periods where just nobody can possibly go delinquent because nobody has a payment to?
That's right.
And so I think that's going to be a big issue for credit scoring going forward.
Yep, great. That's a great point.
Yeah, I mean, I would just add that, you know, the forbearance, the credit suppression was just during COVID. It's since ended.
Yeah.
But I Pete, do you have any comments on strengths and weaknesses of credit scores?
Yeah, just very quickly. I mean, some forbearance only very recently ended in student loans. You know, that was an important decision to reinstitute. Otherwise, we'd have another very large gap in public knowledge. But some of these wounds, these blind spots, are self-inflicted. I mean, when you take a look at what people call the bake-off at Fannie and Freddie between the two credit scores, Inspector General for FHFA issued a report. It said the analysis of credit score models was consistent with applicable requirements, but the agency could improve its process and enhance the level of detail in its decision record. The decision record that the public has as to who won the bake-off, what was evaluated, is a report from the Inspector General full of redactions. We still don't know how the decisions were arrived at. And again, that's something that can be changed by an act of public policy. Congress, the relevant committees, could simply make public how the decision was reached and let investors and the public and others interested know who won, and if nobody won, what criteria were used. I mean, that's a simple call for transparency.
Mike, anything to add?
I don't think so.
Okay, so FHFA just announced that Vantage is going to be accepted along with Classic FICO. So Pete, what does it mean for taxpayers and the general public? And if you have any thoughts on implementation, is it a welcome or unwelcome development? And what challenges will the GSEs face in the implementation? And I may have, and then we're going to go down the line on that question after you give the first answer, and then I may have one or two follow-up questions. A lot of the questions coming in from the audience are aimed toward that topic, so.
Well, I guess my first answer is a rise in antacid sales. I mean, let's just give a bit of background here. We're all aware that FHFA Director Pulte earlier this month issued a 42-word tweet saying, from now on, we will, I'm quoting, will allow, in big capitals, lenders to use Vantage 4.0 score with no current requirement to build new infrastructure. Parents stays tri-merge. Well, that kept people guessing for a couple of weeks as to what that meant, given the fact that we'd gone through this tortuous process after passage of a 2018 law calling for competition in credit score models, the development through a painstaking rulemaking process, a listening process in which probably all of us participated, and the certification of 2 models resulting from all that. But helpfully, FHFA clarified its position with something that looks like 400 words. Okay, we're graduating to a higher level here, explaining that decision. Well, okay, but even in those 400 words, you have uncertainty. They asked the question, will FHFA pursue further changes to the enterprise's credit score reporting requirements? They say, we continue to assess opportunities to lower costs for consumers, promote robust competition and spur innovation, all while encouraging safety and soundness at the enterprises. To a taxpayer advocate, that's backward. I will read the mission statement of FHFA. Ensure the regulated entities fulfill their mission by operating in a safe and sound manner. Those are the very first words of the mission statement. And so here we are wondering, well, from a taxpayer standpoint, you are the purpose-built regulator which took over from the Office of Federal Housing Enterprise Oversight, which had been accused of being regulatorily captured by the GSEs, and you're regulating competition instead of ensuring safety and soundness. That's concern number 1 from that decision. Concern number 2, of course, has to do with investors. What are they to make of this? Is there now another path in credit score competition that they need to think of and worry about in the lending community? Do we have new implementation costs here when we were already thinking ahead to Vantage 4.0 and 10T? Now it's back to 4.0 and Classic FICO. What are they going to do about it? Overall, this is a concern about systemic risk. Credit scores are a tool for measuring systemic risk. It's why a coalition that we gathered of about a dozen organizations involved in taxpayer advocacy, fiscal policy, and others, and they said the credit score should never be subject to policy whims or political manipulation. It can't even have the hint of that. They're predictive tools. And, you know, the recent activities can cause concern among many in the policy community that we're veering off course and that we need a course correction to bring back that certainty, reliability, and predictability.
You know, I think at the consumer level, the consumer doesn't care about safety and soundness. The consumer doesn't care about
right.
the investors.
They will when they get the bill.
Right, but at this stage, right, they just want to know what are the rules of the road.
Yeah.
And every time the rules of the road are not clear and the consumer takes an action and they are declined, the process is more expensive for the consumer. So it's more, you know, the question is, just make it clear.
Yeah.
All right, so I'm an economist, and part of that is I love competition. I think it's a great thing, so sending more of that, I think it's good. What worries me in this particular application is that you have a situation where the people who are incurring the benefits or the costs of a possible action aren't the ones making the decision about that action.
Yes.
Right? The choice of credit score that I might make if I was an investor might be geared very heavily toward, you know, is this loan that I'm going to make likely to be paid off on time? If I'm a loan originator, I might have an incentive then to skew towards the score that's not the best predictor of delinquency, but the one that's going to let me sell the most loans to the GSEs. And then you wind up with situations where you've got competition not driving more efficient markets and more efficient allocations, but competition driving an outcome that fundamentally leads to riskier lending.
We call that gaming the system.
Yes.
That's the technical
And
term.
as an investor,
Yes.
I despise the notion that someone can game me. And if I assume that I'm operating in an environment where that can happen, I will assume that it is happening, and I will charge more as a consequence, if I choose to participate at all. So the notion that this is this goes back to my short-term versus long-term. Short-term, I don't see this saving consumers anything. If anything, I think there's a real risk that costs go up, because I think the cost of capital could go up if this is implemented poorly. If investors are left to make wide assumptions as to what the effect of what a new credit score, the new credit scoring regime is going to be, the assumption investors are going to make is the worst possible outcome in order to protect themselves and their sources of capital. So I think the devil's going to be in the details here, not however number of words is in a tweet or whatever, but how this gets implemented, if you care about what the real cost is going to be to the consumer, is going to be critical. Now, over time, this will correct itself. So in the long run, yes, I buy the economist's argument that competition's a good thing, but it's going to take a long time if it's left to its own devices.
So let me actually follow up on that, because, I mean, clearly, you know, Vantage scores are skewed slightly higher than FICO scores on average. There's a 14 or 15 point difference. So clearly the GSEs need two sets of LLPA bands. They need two sets of minimum score bands. But then, you know, as both of you pointed out, you have the potential for gaming. I, as a lender, am going to may look at both scores and decide which one to use. For the GSEs, that means you have a marginal reduction in LLPAs, but they don't, as John pointed out, they don't actually use credit scores in their scoring decisions. However, for the mortgage insurers, for investors, you don't know whether the lender has in fact pulled two scores. You don't know how big that bias is. Is that
right? That's exactly right.
Is that a good way to
so
think about
it? Whether you're a mortgage insurer or a traditional cash investor, you're not going to assume the best case, because as you said, the economic incentives are for you to do what's in the least interest or the lowest interest of the investor, and that's the gaming. That's the result of the gaming. So the investors understand that, and so, as I said, some investors are going to say, you know what, I've got better opportunities elsewhere. I'm going to pull my capital out of this space. I'm going to move it somewhere else. Other investors will choose to stay in on the premise that, well, I can get some incremental yield. to be compensated for this, and I will let it, and I will basically learn along the way and refine my pricing as experience dictates.
And then the final question, which is the bridge to the next panel, is what do you see as the next generation of innovation impacting credit scoring? And why don't we just, Jim, start with you and go down the line?
I mean, all the attention on AI and blockchain. I'm fascinated to see how the credit bureaus implement what should be a significant improvement in the quality of credit data for consumers. This notion that you're going to have to pull a sample of consumers into a dark room and have them review their credit reports to validate, with this new technology, that should be addressed, one would think. So I'm curious to see how that plays. And then, of course, from an investor perspective, that would be fantastic. If I could have greater certainty around the tools that I'm using to assess risk, that would be fantastic.
Yeah, I'm a little bit skeptical that any of the new sort of machine learning LLMs are actually going to do anything about the quality of data. Because fundamentally, if they see a credit report that only has a $20 Sprint collection fee, they don't know if that's right or not. Right? They may hallucinate some other experiences that this person has and use that to produce a different score. But fundamentally, their ability to discern truth, I think, is limited. So, but in terms of going forward, what I am optimistic about is that I think there are a lot of new sources of data that are coming out available that may be used to supplement what's in the credit records. Right, and here you have the potential where you can take these thin file or no file people and potentially know a good deal more about them and use that to build more accurate credit scoring models. So that's the part where I'm more bullish about, is that I think there's a real potential, to the extent that you can get more data, you could produce more signal about what it is you're trying to predict, and that can lead to hopefully improved outcomes for everybody.
Mike?
Yeah, I agree. I think that the idea of some kind of cash flow based approach, but also that provides some kind of insurance wrapper if there's a financial impact to the consumer somewhere along the way. Some unique product like that is clearly in reach with where we are with data.
At the macro level, there is a better future, a more predictive one, for credit scoring and other diagnostic tools if they are allowed to evolve organically rather than forced to evolve through false notions of what constitutes competition in a public policy realm. And we have to remember the systemic risk always. That's what the 2007-2008 crisis taught us. It gave us a little lesson during COVID. The share of GDP occupied by the national debt rose between 20 and 30 points during those two crises alone, and it didn't recede. Best case scenario in about 30 years, the actually 20, the national debt will be at 200% of GDP, assuming no wars, no financial crises, no meltdowns owing to careless public policy. We've got to pay greater attention to that and let these diagnostic tools do their work.
And great. Well, thank you very much. And with that, I think we have time for maybe one or two questions. So I think the first question goes to Ken. What happens to the data of the rejected applications? The distribution is truncated. Would this have any implications on estimating the score, estimating the number of borrowers that you can capture with the new scores? How do you think about this truncation?
So this is sort of a nice technical issue, but
That's
it's really
why
important.
it went to you first.
Also, it wasn't directed at me from the audience. Okay. So
Yeah, I thought it was an interesting question, and the first two questions actually dealt with implementation that we've already covered.
Yeah. So, I mean, this is a real challenge. That fundamentally, when you build a model to predict credit risk, some sort of credit scoring model, you're building that model on data of only people who got approved applications, right? You don't see how the people who were denied actually perform. So at some point when you build these models, you're worried about the fact that the model's being trained on data that's better than it would have been if you'd seen all the performance. So the issues involved in this, the technical term for them is reject inference. I'm not as good an expert on reject inference as I am on other portions of credit scoring, but it is something you need to think a lot about because it is really a concern. It's part of the reason also why it's so hard to build models for thin file populations. Or if you wanted to produce a score for somebody who had no credit history at all, right? You could produce a number. But the people who you produced that number based on the data were all people who had no credit score and were able to get credit anyway. So they probably had, co-borrowers who co-signed the loan for them or things like that made them better credit risks than, say, the entire population of the unscorable or credit invisible. And so if you then, based on that model, produce an estimate of the delinquency rate for that population, and you introduce that in the market and they start making loans to everybody who has no credit record, you're going to find that the delinquency rates you observe after that are going to be a lot higher than your model was trained on. And it is a lot of it, again, this problem of reject inference and the fact that you only see in the data those people who are able to successfully get loans.
Thank you very much. With that, we're going to have to wrap. We're going to take a 10-minute break. I'd like to, before we, and we're going to move to panel 2, but before, which is how will innovations, emerging technologies, and alternative data affect credit scores and access to credit in the future. That panel is going to be moderated by my dear colleague, Yannicka Radcliffe, who's the VP of the Housing and Community Center at Urban. So we're going to take a short 10-minute break, and if the second panel could go back to be Mike, that would be great. And I'd like to thank my panelists. You guys were fabulous.
Okay, welcome back, everybody. I'm Yannicka Radcliffe, Vice President of Housing and Communities at the Urban Institute, and it is my pleasure to bring us to panel 2. We are going to telescope a little bit out from what's happening today in the mortgage market, look a little more broadly, and also try to take a glimpse into the future. The other thing I'll introduce my panel, but I also want to thank them all for coming from some distance. We have nobody from Washington, D.C. on this panel. We have Ethan Dornhelm, who's the Vice President of Scores and Predictive Analytics at FICO, who's come all the way from California. He may be the farthest traveler today. Don Lemire, who's the Vice President of a firm from Brooklyn. Sarah Weiss, who joins us from North Carolina, and she is the Executive Director of the Center for Responsible Lending at Julian Bond Institute. And then Amy Wipfler, Senior Product Manager, Social Impact from Zillow, who has come from Boston, from Cambridge today. And I guess I hail from North Carolina too, so I'll mention that. So without further ado, why don't we start all the way down at the far end with Ethan. And if you could talk to us about how FICO score models have evolved and improved over time.
Sure, thanks, Yannicka. Well, Young saved me a lot of time with her great overview earlier, so thank you, Young, wherever you are. At FICO, we're very proud to have pioneered credit scores, and we're very proud of the role that credit scores have played in advancing the democratization of access to credit. With respect to the evolution of the FICO score, obviously we launched in 1989, and since then, we've released new scores. We've built new scores on a cadence of about every 5 to 7 years, generally to embed new features or take advantage of new and enhanced data that was available in the credit file. So for example, we're always looking for, I would say, opportunities for win-wins, wins for consumers and lenders alike. And for example, with FICO Score 9, around the time we built FICO 9, new data was made available in the credit bureau file that allowed us to differentiate medical and non-medical collections. That's been a hot button topic for the last few years. But over a decade ago, the bureaus introduced this ability to differentiate these fields. And by doing so in our variables in the FICO score, and for FICO 9, we were able to basically treat medical collections less punitively in the score, a win for consumers, and at the same time improve the accuracy of the score, a win for lenders. FICO 9 was also the first opportunity we had to incorporate rental data into the FICO score. It was the first time we saw the occurrence of both what we'd call full file reporting, both positive and negative reporting of rental data. So that was when we introduced rental data. And we continue with each successive release of the score to build on these enhancements, right up to FICO 10T, which is our latest and greatest model. You heard a little bit about that in the prior session. So again, 10T includes rental data. It has the refined treatment of medical collections. We believe it is by far the most predictive score for mortgage default risk in the market. And we're very eager and excited to see it adopted widely in mortgage and other spaces. I would just take a minute as well to talk about beyond the core file, we've seen evolutions in the score as well. So beyond the core traditional credit file and the core FICO score, we've invested a lot of our R&D. Over half of our R&D over the last decade has been towards what Ken Brevard on the last panel discussed with alternative data, an opportunity to get a more refined understanding of borrowers' financial pictures, especially those borrowers who don't have particularly robust traditional credit files. So we've rolled out in the last decade scores such as FICO XD, which looks at telco and utility bill payment information. We've rolled out Ultra FICO, which leverages cash flow data, consumer contributed cash flow data. It layers it on top of any credit bureau data the consumer may have to, again, try to drive to more approvals for consumers.
Well, okay, so I'll come back to that in a minute, but you mentioned 10T. Is there you had some recent research report on that? Can you share some of the findings?
Yeah, and I on the earlier panel as well, I noticed that sort of like driving into like, well, how much more predictive is it? Well, we recently published a white paper that really attempted to provide clear quantification of how much more predictive 10T is than the other scores in market. And with the advances in technology, with the advances in the data being leveraged, we found that the score offers well over 10% improvement, again, in default risk prediction in the mortgage space compared to other scores in market. And I'm not just referring to classic FICO, which at this point is an over 20-year-old score, but I'm also referring to Vantage Score 4. So this white paper, it's on FICO.com. If you haven't had a chance to read it, I encourage you to do so. We address a lot of the questions that were raised in the earlier panel. We look at different time periods through the cycle to really confirm what we found, which is that 10T not only includes rental data, not only includes all of the 7 generations of enhancements we've baked into FICO scores over the years, but is also substantially more predictive than every other score in market for mortgage risk.
Well, I assume, though, you're already working on your next score, right? So when you started to share with us some of these extra new sources of data, I'd love to hear what you think are going to become, what are the new sources of data that you think will be layering into the next generation?
So
or what would you like to include?
Oh, ooh, that's a different question. I would distinguish again between the core credit file and beyond the credit file. So with respect to the core credit file, one of the things I know we're going to talk about on this panel is rental data. I was actually here at the Urban Institute about 6 months ago talking about this very subject, that rental data seems like a very natural, very logical piece of information about a consumer's payment history to incorporate in any understanding of their overall financial picture. And we have made, the industry has made big strides getting more of that data into the traditional credit file where it can be incorporated into scores like FICO 10T. That said, we've got a long ways to go. As Young's slide showed, less than 5% of renters basically have their payment history captured today in the credit file. So growing rental data coverage is one area, and I know Amy's going to talk about that shortly, so I'm not going to steal any thunder there. Another area in the core credit file, BNPL. We have Don here. He's going to talk about his great work, I'm sure, that he and his team at Affirm are doing, trying to drive more coverage there. But there's no question, significant portion of U.S. consumers are using BNPL as part of their financial strategy and financial picture. And the fact that that's not seen currently by credit scores feels like a real opportunity for improvement.
Great. I love a self-moderating panel. So that brings us to Don. Why don't you talk to us about, buy now, pay later lending and the emergence and what kind of, where you're headed, who your customers are, and how does that, of course, relate it to this topic for today?
Yeah, absolutely. And I'm excited to be here. Thank you for having me. So BNPL has been around for about a decade now, and it's really grown over the last, I would say, 5 or 6 years. And really the genesis of it was there was a need from a merchant perspective when they saw it when it was first introduced. It increased their sales, and for a lot of particular users, like they found it as a very flexible, transparent, closed-end way to make payments. And we've only seen that grow again and again and again. And I've had the opportunity to be with a firm for about 9 years now, which makes me definitely an old timer. And it's been really interesting to see kind of the relationships we've built with the users who've kind of, put their trust in us and told us like, hey, this is our preferred way of, managing credit and making payments. And so one of the things I always got to look at was, okay, this user's been with us for years and years and years, and we're starting to see them kind of replace other forms of credit, maybe their revolving credit card, with more BNPL usage. So they might be using us, 6 or 7 times a year, maybe spending $3,000 to $4,000. And we were looking at them and say, whoa, these are people who are really building a lot of, we have a lot of more trust in them. We want to offer them better terms, better access to credit. But there was a bit of a fear of, hey, this is growing across the industry. No one's necessarily reporting. How are these models that are being used, like FICO and Vantage, going to necessarily look at these users? Is it going to be positive? Is it necessarily going to be negative? Because this is something new and quite ubiquitous. How will they necessarily be identified? And so through a lot of the work that we did with FICO, and Ethan's been such a wonderful partner with a really wonderful team, we found that it was really positive for the overwhelming majority of people. Not only can we make the credit scores more predictive, which we know leads to better and cheaper access to credit, a lot of users who might have been, let's say, no file, thin file, or in a period of repairing credit, they were putting themselves in a position to get a cheaper auto loan or even access to a mortgage. So for us, like, it's become something that not only feels good, but is really mission aligned with our company. So us at a firm, we really want to continue to push this industry to do more credit reporting, across all of BNPL landscape.
So, and one thing that I found extraordinary when we talked ahead of time was just to give me the magnitude and the growth trajectory of BNPL lending, so we can understand how it fits into the bigger credit picture.
Absolutely. I unfortunately don't have like the numbers necessarily in front of me, but I got to imagine we're originating, across BNPL probably well over $100 billion a year, and that continues to grow, double digits year over year over year. And what we're finding, especially within our company, is that it's a full spectrum credit product. We lend anywhere from, super prime, 850 FICOs, down to deep subprime, no file, thin file. It really is this like wide-ranging inclusive credit product that just, again, continues to grow.
So what's the relationship between credit scoring and BNPL lending?
Well, for us, it's about providing more transparency in the market. Like, our job at a firm is to make sure that we are making smart and effective decisions with every transaction. We don't charge late fees. We have every incentive in the world to make the right decision and have that trust that a customer is necessarily going to pay us back. And we're often rewarded by putting that trust in the user. And so, by giving that customer the benefit and kind of demonstrating and say, hey, look, this person's been a great repayer for us for years. Like, we want that person to benefit in other ways as well. Like I said, getting cheaper access to like auto loans, access to mortgages. So we just see it as something that, improves the lives of our consumers. And again, it's just very mission aligned with what we want to accomplish.
And then just real 101 for me, it's like, are you reporting all the lines to the credit reporting agencies, and then are those going into credit scores?
Yeah, very good question. So today we are reporting all the information that we do generate or originate for our users to both Experian as well as TransUnion. But as of this moment right now, that information is not yet being sent to other lenders nor FICO. But that's something that I hope in the near future is going to change.
Okay.
That was actually a really key insight of the study we were able to do thanks to a firm's data, which was this BNPL data, this product is so unique and distinct from the, call it, traditional types of credit products that have long been in the credit file. You cannot simply flow this data into existing algorithms. You need new algorithms that are purpose-built and thoughtful about how to approach things like the fact a consumer can open 5 of these accounts in a week. Not that they're often doing that, but they can. That's something we never saw with the type of data that was historically in the credit file.
Fascinating. That's really interesting look ahead. All right, so Sarah, now we get to hear a little bit from perhaps more the consumer side. Why don't you talk about your organization, how the research you're doing informs this question?
Yeah, great. Well, thanks for having me and for the Urban Institute for putting on this very timely and important and relevant event. So I work at the Center for Responsible Lending. We're a national nonpartisan organization that does research and advocacy in the consumer finance space. And so in my role as the research lead, we're constantly looking for fairer financial opportunities, systems that can be designed that can serve consumers well and open up a more inclusive marketplace that also is still accurate. And so in that vein, we've recently launched the Julian Bond Institute for Financial Equity Research, where we're continuing to do that very type of research, doing a mix of big data work as well as qualitative work, deeply embedded in the communities as well that we're serving. And so making sure that our research agenda is being set with the true needs of consumers, and then conducting robust and high quality research in the space.
Great. I'm so glad you're here.
Thanks.
So tell us about what your thoughts are here about, for example, we've heard a lot of great conceptual ideas here. How do you think this is going to actually play out for consumers? And are we, Jung says there's some evidence of all these new pieces of data sort of improving scoring and access to credit, but like, can you help quantify that?
Yeah, so I love that you started by saying let's zoom out a little bit. So giving a little more additional kind of ground truthing and context I think would be really helpful here. So in terms of credit scores, they can be very predictive, but there are also some problems with them. And I think on two key fronts. One, on basic fairness of scores and what they capture and represent. And the second is on some measurement issues, some of which have been addressed already in the earlier panel and here. So starting with basic fairness, it's a well-cited Urban report and others that show that there are huge disparities and gulfs between credit scores by race and ethnicity. So the average score of white Americans is 100 points higher than blacks, 115 points higher than Native Americans, 57 points higher than Latinos and Hispanics. This translates into very different opportunities and costs of borrowing that take place over the course of an entire lifetime. So there's a path dependency to it that's driven largely by disparities in intergenerational wealth and access to early abilities to have credit or have good credit scores. So the most recent estimates I saw from the CFPB have updated how many thin or no credit individuals there are. It's 1 in 8 in the country. So just on basic ability to measure, that is one clear limitation. And beyond that, the racial wealth gap, which is a very deep divide in resources among folks of different backgrounds, shows that for the average white family compared to blacks or Hispanics have 5+ times the amount of wealth. And so what that means is when there's a new person entering the credit market, a young person, if they're able to be an authorized user, say, on their parents' credit card, they start 40 points higher of a credit score than peers that can't do that. And those differences persist through their 20s. So again, the overall fairness of what it means to be able to rely on, say, a PLOC, a parental line of credit, instead of at being about true credit worthiness, I think is something that we just need to think of as the macro context here. Measurement as well, it's pretty challenging, especially with so many forms of alternative credit, and I think it'll be great to hear about cash flow underwriting and sort of think about how that can be used and paired with credit scoring. But even in that space, as a data wonk myself and somebody who loves data and who works with both credit scoring data and transactions data, for as messy as credit reporting data is, transactions data is even messier. And so it's not a silver bullet. I think that the measurement challenges are going to continue to persist and is something that we collectively need to work through. Nonprofits, research, industry, kind of in partnership, figure out how to make sure that we are being intentional about thinking of advances in credit reporting.
So we talked a little bit about some of the innovations. You mentioned some. Can you discuss how they can or cannot expand access to credit or create harm potentially? How do you look at it?
Yeah, sure.
That
So
balance.
We had a panel earlier on housing finance, but we've done some research at the Center for Responsible Lending that looks at credit reporting and the two other big drivers of homeownership: down payment, enough for a down payment and enough to pay principal and interest, so your monthly payments. And of the three, credit reports really aren't the driver at all of not being able to purchase a home. It's having sufficient income and having an affordable home in the area. And so I think at the margins, there are definitely advances that can be made, especially for those that might be unscored or have thin files. But I am going to kind of hedge on just how much this is going to be the problem solver for everything. Because I think that there are that there are some limitations in how much that will be possible.
No, I get that, but I also know, been around long enough, I remember when the 1995 letters came out telling to use credit scores in underwriting mortgages. But there was a time when people did use rental pay history and cash flow underwriting pretty regularly in mortgage processes. So it's sort of become new again because technology allows us to do it. And so I'm optimistic to hear what Zillow is going to do and innovate in this space. Amy, do you want to talk about that?
Definitely. Well, so excited to be here with all these awesome experts, so thanks for having us. I work at Zillow on our social impact products. That means I have the privilege to get to work on products specifically across the platform that increase housing access and housing affordability. The reason I'm up here today is that about 2 years ago, we launched our rent payment reporting product. The way that works, you may only use Zillow to search for your next house to buy or check your estimate. We also have a very large rentals platform. That rentals platform has a tool for landlords called Zillow Rental Manager. Landlords who use that tool often manage their leases and payments through it. And we at the social impact team were like, wow, we have all this payment data. It's coming through our systems every month. There's this rent reporting thing. And so we launched an opt-in program. So anyone who was already paying rent through Zillow could opt in to share future rent payments as well as up to 24 months of past payments for free to Experian and Equifax. And it was a little experimental. We didn't quite know how it would land. There's not a lot of real estate companies doing this sort of thing right now. And we have seen fantastic uptake. 2 years later, we have 65% of people who are paying rent through the platform choosing to share this data, which I think shows huge consumer interest when they have the opportunity and the control over their data to get credit for what they're doing, right? Rent is often the largest monthly payment anyone's making. And the fact that it's not showing up in 95% of credit files is something I think most consumers would love to be part of solving because that is really resonating with our audience of like, you get credit for paying your rent on time. Part of the reason we're doing this is because wherever you are in your housing journey, credit is going to be a barrier to overcome. Arguably almost larger if you're trying to rent a home than buy a home right now. In competitive markets, you often see landlords requiring a 750, even higher, as a tenant screening tool. And obviously they're looking to protect their investments and find the right tenants, but I think a lot of them don't think about the fact that score probably doesn't incorporate on-time rent payments, which is likely the thing they're most concerned about, right? As a landlord, I'm like, I want to know this person's going to pay me back on time. Well, that's the piece of data that's not in the score you're using. So we're really thinking about how can we, one, start to help solve those barriers that were on a prior slide. So the data collection piece, how can we just start to have more people have this data? We have a very large audience. We would love to be part of that movement. And then additionally, help people think more diversely about what does it mean to be a creditworthy rental applicant. And that's where we're curious about things like cash flow and on-time payment history, really getting at like helping landlords understand more diversely who's applying to their rental is something we would love to explore more. And then beyond that, the home ownership journey. Our research shows that people really are still dedicated to being a homeowner one day. How can we help in their credit journey make that super streamlined, super accessible, super understandable? A lot of the things that we talked about on the prior panel, I think mentioned how consumers don't understand what's going on with their credit. They don't feel in control, they're scared. I think it was like 23% of people don't even want to check their score for fear of it dropping, just from looking at it, right? It's like that closet in your house. You don't want to look at it. I don't want to deal with that stuff. And so that person is never going to have a chance to like work on their credit. So how do we start to just help people feel more in control, understand what their score is, what it does and does not qualify them for at the right moment in their housing journey, and how can we as an industry work towards a more consistent score that works across all of those transactions? Because when you get into the models and the complexity and the bureaus, you lose people at that point. They're just like, nope, I just want a house, right? And so we are also trying to think about a future where how can you have one score that kind of travels with you through your housing journey, however many moves you end up making, you can just have consistent, reliable trust that that's how you're going to be judged by the people you're presenting yourself to. And so that's why we've built these products, and it's really aligned with our mission to get more people home.
That's great. So all these records are going every month to the credit reporting agencies for rent reporting.
Yes.
And now they just need to find their way into the models.
Yeah,
for mortgage underwriting.
we're very hopeful. I stay tuned a lot to FHFA's newscasts because we think that that's essential, and I think it might not happen tomorrow, it might not happen in 6 months, but that is the way the industry is going. I think people on this stage all agree, specifically rent payment reporting, it just makes sense as an equivalent for a mortgage payment, ability to repay, and so we're very aligned with like getting to that point where this data is more updated, it's more inclusive, and we're also looking to scale what we have today. Right now, your landlord has to be using this platform for you to get this benefit, but we're hoping next year to be expanding that to more of our audience to continue to reduce barriers to getting this on your credit report.
Great. So we're getting some good audience questions. I know I'm supposed to like wait to the end and ask those, but I'm going to try to mix them in a bit. And I wanted one just because I think, Don, maybe there's more of a clarifying question that can help ground the conversation a bit.
Sure.
Can you provide a bit more information on who uses BNPL, characteristics, income, age, et cetera, and whether their payment behaviors differ compared to other types of loans?
Yeah, so this is going to be a little bit difficult because I can represent a firm, and it's going to be a little bit more challenging for me to maybe represent the larger industry. So speaking personally about our type of customer, we have everything, from Gen Z to Boomer. So it's quite a wide, and I guess Gen Alpha is they're coming of age too now, which is kind of weird to say. But we see this really wide age distribution as well as income distribution as well as credit distribution. So our product is available at a variety of different places. You can use it at Walmart or Target, or if you're buying a Peloton bike or a mattress that's more expensive, that's another option. So we are seeing it used, again, pretty ubiquitously across a variety of different type of use cases, much like a credit card is used ubiquitously as well in the credit and lending environments. And then what was the second part of the question?
Payment behavior.
Payment behavior, yeah. Again, for us, our payment behavior has been really, really strong. One of the things I observe is, our customers pay us back really well. That's kind of been also rule one of our company is responsible lending. So I've seen just really, really strong repayment behavior. And even in certain cases, I do see people look at their Affirm loans and say, well, this is a closed-end installment loan with pretty manageable payments. I'm going to choose to continue to pay this down as I'm out of debt. I'm not paying interest, and that also continues to provide them utility if they want to use the product again. So for us, it's been really, really strong. But that's also again because we do kind of lean into that responsible lending part of our mission.
You mentioned this sort of that you see the snowball effect on those who are saying, if I can just get the BNPL paid down, I can see the end of the
exactly, yeah.
tunnel.
So one of the things that, and again, this is a little bit anecdotal, but it's something that I'm looking at a lot, and I see it quite a bit. But I do find people when they look at their hierarchy of debt, so to speak, they say, okay, well I have these a few Affirm loans, one's $250, one's $400, one's $500, and then I have a $6,000 revolving credit card that I'm compounding interest on. I'm not getting as much utility from that revolving credit card anymore, but these payments that I have from Affirm, that's largely principal balance, I'm able to pay those down. I'm able to kind of remove those from my debt and then move on to the next. So again, it's been pretty favorable.
Interesting. Okay, learning a lot here about that. So I would like now come to something, you kind of mentioned opt-in, and it made me sort of think about some of these, the borrower understanding, and also the sort of, I think we really need to be clear when we talk about this alternative data around a lot of things like, is it full file? Is it positive only? In fact, there's also negative only things like the medical collections issue that's been in the news a lot lately. How are you thinking about, I think, I'll start with the two of you and maybe FICO to sort of tell us how that factors in, but Don, feel free to jump in as well.
Yeah, I mean, we are very much mission oriented in doing this work, and so it feels really important to make sure it's opt-in, and anytime you don't want us to do it anymore, you opt right out. You know, it's your data, it's your choices, it's your ability to pay rent. And so that's, I think, honestly, one of the reasons we've seen so much uptake of it compared to what we thought we would see. And then additionally, we are doing on-time payments only. It's not necessarily to say that that is going to be the forever future of how these trade lines work, but it's more that in this moment where we don't have confident data about how this is impacting scores, where, you know, FICO only has 5% of consumers to even experiment with, right? Like, we don't want to be doing any harm. So I think it's really important when you're working with emerging technologies or new data sets that you kind of try to first experiment with what is going to be most helpful. Honestly, if you're paying your rent over 30 days due, right? Because the bureaus, it's still on time if it's 15 days late. But if you're over 30 days due, you probably have a lot of other things that you're struggling with. You might be facing other issues with your housing, and so we don't want to compound that. And we actually see people misunderstand this all the time. They write into support. They say, "Oh, I thought, you know, I'm 2 days late. Is that going to hurt me?" Right? And they're looking to us as an expert. They're saying, "Hey, is this right? Should I unenroll? How do I do?" And so I think people are just very nervous, and still there's a lot of education opportunity there. So we always give them peace of mind. You got 30 days. Don't worry about it. And we also just think that until we have really more confidence and we have more people enrolled in these kind of programs, so that we can run the different scenarios, that is the right structure for now, specifically for rent payments.
Adding to the opt-in question, I think it is very important for consumers that that there is the option for opting in instead of it being an opt-out. One of the reasons is that you know, giving consumers control of their data puts them in the driver's seat, helps them, you know, be more involved in the process. Yesterday, I was looking back at the CFPB consumer complaints data, because it is always the case that the most common complaint is on credit reporting. So in the last 12 months, there were, I think, 4.3 million complaints, of which 7 out of 8 were on credit reporting. But interestingly to me, of the 4-ish million, about 1 million were on unauthorized use of credit scores. And so it seems to be a big and pervasive issue, and we don't want to exacerbate that as we're trying to work towards more positive developments for consumers in the space.
Yeah, and just to piggyback off that, I think when you do this with the consumer in the driver's seat, you see the right outcomes. We've seen fewer than 0.01 disputes on our reports. And I think it's because people know what's getting reported, they know it's theirs, and so they're not worried, right? And so I think it's good across the board, because then you don't have, you know, these disputes piling up and messy data. So,
but opt-in and positive only are not exactly the same, right? So could you talk a little bit more, Sarah, about the positive only versus the full file and what your view is on that?
Yeah, so I first will say I think that this is an area that needs a lot more research to know what the implications are of different types and amounts of reporting. So it's clear that there are certain industries that do negative-only reporting. This is common in utilities. It's common in medical debt on the collection side, and those negative trade lines or collections have very long-lasting and negative impact on consumers. It's on a credit report for 7 years. All of the resumption of student loan payments have led to huge drops in credit scores for millions of consumers. And so I think we need to think very critically about what it means to have negative only or full file or something in between, and do the appropriate studies to model out what is predictive, what's not, and what might be harmful or beneficial to consumers.
Which takes us to Ethan, but you've been studying this.
Yes, certainly. I mean, Sarah's exactly right. We need to focus on what's predictive. And the analysis has found that, for example, 2 borrowers, all else held equal, one who has a medical collection, that borrower does represent greater repayment risk for traditional credit obligations. So when we talk about responsible lending, when we talk about protecting the safety and soundness of the lending ecosystem, I think it starts from a place of making sure that there are tools in the market that allow lenders to understand as completely and as accurately as possible the financial situation a borrower is. Through that, we can ensure that the consumer doesn't get overextended on debt they can't afford. And as the prior panel mentioned, we can avoid that elevated level of uncertainty in the lending community about the tools they're using that leads to higher cost of credit for everyone, leads to tightening of credit and actually less credit being extended.
Go ahead.
As one counterpoint on that, I think that there was a clever CFPB study that looked at loans that were issued to folks that were going to have a future medical collections, but between the about 6 months of the delinquency and the reporting, took out loans. And so before their credit got dinged, it didn't actually have a demonstrable impact on their repayment of the loans in that time. And so I think that the world is shifting right now, and especially in the medical space with rulemaking and rescinding of that and court cases. But so I'll chalk it up to we need more research. But I am a little concerned still about the implications of having medical debt on reports, especially because it wasn't, it is semi-random who ends up with those in their files.
I think if I can jump in here, I feel like there's two different purposes being contemplated for this alternative data, maybe conflated a little bit. And one is to give people who there's not enough clarity around their credit history, or the thin file paints one picture where their additional data could show that there'd be good credit risk. So that's more like expanding the credit box by taking the people who'd otherwise be rejected, introducing some additional information and making them eligible. And then there's we heard a lot about this from the investors before, the predictive as possible, every piece of data, we've got to just get it as fine honed in as possible, and there might be some tension between those two. But I just think in all these conversations about alternative data, we need to be really open and clear about whether we're talking about opt-in, opt-out, positive only, negative only, full file, et cetera, and the purpose for what we're doing it. And so I don't know, Ethan, if you were going to jump in.
I think it can be both.
Yeah.
We talk about rental data. I know Jonathan Lawless from Built is somewhere in the audience. He cited about 10% of renters are struggling with their rent payments. That's 9 out of 10 who aren't. That indicates that even in an atmosphere of full positive and negative reporting of rent, the majority of borrowers are going to stand to benefit. So, there are opportunities, I think, to at once both continue to ensure the accuracy of the tools and the underwriting system while providing, considerable opportunity for millions of Americans to demonstrate their creditworthiness.
Okay, so let's see. We have some more detail here on how it works, and maybe Zillow knows this, and maybe you know it as well. If FICO's looked at this, whether there's any differences in the outcomes of rent reporting, if the data is coming through the landlord-based rental payment reporting versus the analysis of cash flow data that demonstrates that the payments are being made.
We have not run that study. I'd be very curious. I do know that we're hoping to do more research on the outcomes. Again, it takes a few years, so we don't really have anything to release at this point, specifically on the scores, but I hadn't really thought about comparing it to the cash flow side. We don't always have insight into the cash flow. We just know what their lease requires and how much they're paying, so I'll pass it over to Ethan on that one.
This gets a little bit in the weeds, but with the cash flow approach to sort of imputing rental payments, you're not going to know the quote-unquote date the lease was originated. By definition, you can't quantify missed payments in rent because you don't know if a given month was missed because they chose to pay a different way than that particular account that they've submitted. So for those reasons, as I think about it from the standpoint of impact to FICO score, if it's reported directly to the bureaus, we may see date opened, we may see missed payments, whereas if it's done through the cash flow approach, it's less likely that we will see some of those fields included. Whether that helps or hurts the score, actually, I guess with respect, aside from the negative reporting, I can't really say whether it could actually impact the score in either direction.
So to bring Don a bit into this, but also to try to tie it to the conversation we were just having about how much can the inclusion of the additional data help the borrowers who are more at the margin, and as Sarah mentioned at the beginning, this is already an indication of lack of just wealth to fall back on, and then they do, is it, yes, 9 out of 10 renters are current, but are those already renters with high credit scores? And sometimes if their credit scores are high, it may not be that the rent is even helping them. It can sometimes even, just because of newer trade law, things like that might actually reduce the score marginally. So, I'm curious to, as we think about these new methods for bringing in new data, but also the stresses that certain segments of the consumer market are in. I know we see that BNPL delinquencies are going up slightly. Like if this becomes now more part of the data that we use to assess credit, what are going to be the implications again for the most marginal borrowers?
Yeah, so there's quite a bit in there, but through that additional transparency, like most lenders want to get paid back. And so if I'm at a different lending institution, I do want that complete and transparent picture of how a person is performing so that I can make like an accurate and reflective decision of what this person can, have the ability to pay back. So if I know this person has, let's say, $500-600 of additional payment obligations, that might factor into the credit limit I give to them because I want to say, well, if I give you $3,000, I might have this, 10% risk of not getting paid back. But if I also knew you had other payment obligations coming in, I might only extend you $1,500. But in reality, that could also be a very good thing because you're not further extending the customer, and they are able to make those payments responsibly. Now, again, going back to the comment of necessarily BNPL delinquencies increasing. Again, I can speak for our company as opposed to the industry, but we're still seeing really positive consumer repayment. Again, that also comes from the trust, but the discipline we have and the way we extend credit. In this environment, you have people who might try to grow through their originations. We're also in a period where, loan buyers in the private credit market are exploding. There's a lot of money pouring in. So there's kind of artificial demand trying to meet that supply. And then, third and very importantly, everything is a lot more expensive than it necessarily was 5 years ago. For 80 to 90% of Americans, like their wage growth has not been able to keep up with the rising costs that have occurred. So not only, I'm sure, is BNPL in general necessarily seeing those rise in delinquencies, but I imagine you're seeing that as well in the auto industry as well as credit cards.
Mm-hmm. Yeah, consumers under stress. Okay, great. We've got a lot of questions coming in. We've got 10 more minutes. I did want to get future oriented, so let's bring AI into the conversation. Just anyone who wants to jump in talking about how AI we've talked about new kinds of data, but also sort of new ways of sourcing it, but also making sense of it. So who wants to start us off?
I mean, honestly, when I think about AI in this space, I'm actually less about computing scores, and I'm more like financial coaches. Like, the things I've seen agentic AI do, really cool. And people who are facing these barriers are often very reticent to get help. They're not willing to go to a lender to understand their situation. They're likely not going to have time to go to financial counseling. I think it's going to be interesting to see how does AI emerge as like a partner almost in being like, okay, go pull your credit reports from the 3 bureaus, import them, let me give you some advice. I mean, there's a lot of opportunity for like bad outcomes.
We're going to go to Zillow to get that done, aren't we? Going to be doing that.
We do not have your credit reports on across the board. It's more just like, I think it's a really, I see it as helpful, and I think there's actually a huge social impact in that so many people don't get access to this education. If your parents aren't in a position to give you this education, and you're not one of the lucky 10% of people who get financial literacy in high school, like how else are you going to learn about this? And so I do think a lot of it is kind of nurturing and having someone who's there to like guide you and coach you on these steps of like, what does it take? It's not straightforward to raise your credit score. You're like 30% utilization. Oh, but it's not just one card. It has to be all the cards, right? It doesn't always make sense. And so I think I'm actually just excited in that I think it can start to make sense of a very opaque system for people.
Very cool.
Yeah, I can talk a little bit about from the modeling perspective, and this is just my perspective. AI is going to do both good and bad things for fraud. It has the ability to create, bad actors who are now going to have, a much bigger toolbox to go to other lenders to attempt to take out and defraud these lenders. And in doing so, that always harms, good borrowers because they're now going to have less access. But the flip side of that is true in that AI is going to, in the fraud space at least, become pretty strong at identifying those patterns of behavior and hopefully, try to counterbalance like what the bad actors might be able to perform. As it relates to credit lending, I'm a little bit more pessimistic of the AI tool sets here in both the short as well as the near term, both because I think there's a long way to go with pretty traditional machine learning techniques and what the previous panel discussed about improving credit scores. I think what the tools available now still have a long ways to go in terms of improvement, and it's also just a little bit easier to continue to use those tools. And then two, I would be pretty concerned about fair lending concerns and AI effectively creating issues and winners or losers in that space. So still a little bit more trepidation in that particular realm.
Okay. Yeah. Sarah?
I was going to say also, there are many flavors of AI, and so in the machine learning space, I think with the huge amount of data that we have and will continue to have, that there are going to be applications of machine learning just to process the data, and so maybe that's the more boring kind of AI, but I definitely think that that will be necessary as we just try to wrangle the big data that we have.
So it's like you can't really talk about AI and not also talk about the sort of future forward thing. Like one of the questions was, are we going to incorporate future earning power into credit scores and things like that? So I feel like, I don't know. So maybe as we continue to have this conversation and it moves on to Ethan, it's the AI, but it's AI plus the data, right?
Well, AI in some ways will create the data, and that I think gets to some of the risks that my fellow panelists have been talking about. I mean, AI is incredibly fast. It's incredibly powerful when it comes to finding like important signal in the data. It's also very difficult to parse apart exactly how it's arriving at that signal. And that can be extremely important, especially when you're dealing with new types of data sources. Listen, we've been staring at credit bureau data for 35 plus years. We have a pretty good idea of how to extract the signal from that data. But when you talk about something like cash flow underwriting, I'll give you an example. We looked at 100 consumers, like, totally depersonalized, but we just looked at their bank account data, totally depersonalized, but we had the transaction date, the amount, and that description field you see in your statements. In 100 consumers, we saw a consumer sure looked like they were paying a rehab clinic. We saw another consumer who looked like at 2 a.m. they were withdrawing money from a casino. So the question becomes, AI may find real meaningful signal in that. Who's policing AI to say, wait a minute, we're not interested in including a variable like that in our model? And that's, at FICO, we use AI kind of at the front end of the development process to help us separate the wheat from the chaff. Like, we got 5 data sources we could potentially incorporate in these models. Which one should we spend really our time and energy building models on? And AI can give you a good idea of where to prioritize. But after that, we make sure that a domain expert is firmly in the loop, like hands on the steering wheel, guiding any decisions about what variables, what data ultimately makes it into the final algorithm.
May I say one other data point? So on the transactions data, we use transactions data, and it can be great, right? So you get a very detailed picture, anonymized, of consumers, but often you still aren't getting the full picture because you might have a linked single account, so you don't see other accounts. Sometimes non-bank information isn't there as much. If you have money sitting in Venmo or Cash App or somewhere else, PayPal, it's not necessarily there, so you don't see a lot of the transactions. So I think figuring out also how to model around having what seems to be much more complete information, but is still rather incomplete, is going to be one of the future challenges we need to work through.
Now, before we get too negative about this type of data, before the product manager in charge of Ultra FICO goes after me after this
they're
panel,
not watching.
I will emphasize, so we steer clear of those sorts of like in the weeds transaction categorization type variables. Just the concept of cash flow, inflows relative to outflows, how that has trended over the recent past, that can have meaningful predictive signal. To Sarah, maybe it would have even more signal if you knew with confidence you had all of the borrower's financial accounts. But even with what data you typically find, which is the data the consumer is willing to opt in and share with you, there's meaningful insight into how much cash flow the borrower is generating and how stable that cash flow has been over time.
We'll still use transactions data, but
right.
yeah, there just are some limits to it.
Right.
Yeah. Well, that honestly gets almost at like why I really hope the updated scores get used, because what we're talking about in all of this is just having a fuller picture of who are you serving. And we heard from the investor perspective, like, I want to understand my risk. How can you understand your risk if you only have a third of the picture. And so if you have rent payment and you have a little inflow outflow view, you've got a much fuller picture. I mean, I think we all acknowledge getting to 100% is really tricky with our financial systems the way they are. But even having 70%, way stronger, right? And so I think it's just that we have these technologies, we have these opportunities, and that's why I think it's really exciting what the updated scores could do, because they're just bringing in these large expenses, right? Like more houses are like paying more rent than ever before. It's the biggest part of their month and monthly payments. And I think we just need to be thinking about that when we're thinking about the risk part all the way from end to end.
Great, that's good. So I'll just run down the row, since you kind of put us in that, help us think about a prediction. One prediction, 10 years from now, how will mortgage borrowers be assessed versus today?
I think they will be assessed diversely and through probably machine-assisted like enhancements. Again, at the top of the funnel.
Top of the funnel.
So 10 years is a long time and not a long time,
Yeah,
right?
maybe I
So-
should have said, like, with thinking about Jung's timeline, we might have needed more than 10.
Yeah, so I think in 10 years there will be more machine learning in the models. FinReg Lab and others have shown that when you pair cash flow analysis with credit scores, it can be more predictive. And so I think that we will trend in that direction. But how quickly markets will shift, I think I'm not sure what exactly will happen by 10 years' time, but I do think there will be a lot more data involved.
I will, echo a lot of the same points and definitely say more equitably, provided we continue to increase, banking transparency.
Gosh, in 10 years, I hope FICO 10T is being used for mortgage origination.
10 years to 10T.
Yeah, and I do think cash flow will have a more outsized role in not just the verification we see it used for today, including, I guess, rent payment history verification, right? We know the GSEs have both done pilots on that, but actually for risk underwriting. And I really do believe it will be much more seamless for consumers to opt in, for consumers to share their data. I mean, we've made great strides, the industry has, but I think there's even better yet to come. And again, the more predictive these models ultimately are, I think the more opportunity to approve more borrowers, to gain more mortgage access, and to gain mortgage credit at more affordable terms.
Well, I can't wait to come back in 10 years and see how we did on these predictions. I really want to thank all our panelists. They really did a terrific job. I'd like to thank the audience for hanging in there. We have some great questions here that I didn't get to from online folks and folks in the room. I also kind of want to acknowledge the CFPB came up a lot today. I know there's a lot of people who work there, have worked there, and have contributed to this body of knowledge on credit reports and credit scores, so I want to recognize that. I want to make special thanks to all the folks in the Housing Finance Policy Center and Urban who contribute to this knowledge as well and to create the forum that we can share it. That's our AV and technical folks online and in the room, our tremendous events team. We have volunteers who gave up time to meet you at the door. And I especially want to recognize the secret sauce to all of HFPC's events is Erin Coons, and it's her birthday today. So she spent her birthday with us talking about credit scores and reporting. That's really remarkable. It just shows you how fascinating this topic is and our panelists. So thank you all very much. And join us for the reception.